Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, December 13th, 2021. It's 11:18 Eastern Time as I'm starting the video, and here's what we're going to do in this one. I'm going to start out with a very brief update overview of the price action on the market, just show you where QQQ and NQ are at. I'm only focused on the short-term 60-minute charts now. I've done the long-term charts quite a bit recently. Then I'm going to go through just a handful of the top components of the Nasdaq 100, and then a handful of the bottom components, so the smallest weighted in components in there, and that kind of segues into the rest of the video, which I'm going to go over, and that's my breadth indicators. I've been talking about deterioration in market internals for weeks, if not last couple months now, and guys, I know I've covered that in recent videos. If you've seen it before and don't want to see the updates, just maybe watch the beginning of this video on price action. And I'll also throw out a few potential trade ideas because there's quite a few stocks that are at support. So while I still favor another leg down in the market, and once I'm finished with this video, you'll see why I'm still open to not just a move down to my next near-term targets, T3 and T4. We already hit T1 and T2, but a much bigger drop. Again, to me, the breadth indicators are, they're not yellow caution flag, they're red flags. They're in on pretty much, I'm not going to say uncharted territory, but they're really flashing some issues, if you will, with the market. So let's dive in here. Let's start out with price action. I'll get to those breadth indicators in a second. All right, so this is QQQ. We know the story. We had sell signal 1 on that break there, trend line break, secondary trend line break right here, sell signal 1, 2, big level there. It's kind of pushing the again, I've talked about it. There's no hard upper limits to a bounce, but 401 is a pretty big level, and we're still below it right now. And we did put in a little bit of divergence there on the RSI recently. And what happened is last week we came in for a near back test to the top of the gap, not quite there, and we're still above it. So here's these are the levels to watch. We're still pinched between 401, which is resistance. Bullish if that's taken out with conviction, and then you only have the previous reaction high above is the next resistance, and then support below is going to be the top of the gap there, roughly about 393. If the gap is entered, chances are we'll backfill it. If it's entered, solidly move down in there, 60-minute close. Bottom of the gap is about 387.64, and then if that goes, as I'm still favoring, we'll come on down and hit my my next targets of T3 zone and T4 down there. And the case that I'm going to make in this video is quite possibly more. So I'll certainly give you additional targets. I've already done that actually in recent. I've covered quite a bit on the daily chart, the longer term potential targets. So we're just going to skip over to the Nasdaq 100 futures right now, NQ. We've now rolled, or I've just rolled to the March contracts, so that's what I'm going to cover now. So these levels might be a little bit different because we were on the December contract. That's the chart I was using up until today. So, but it's the same. I've replicated the lines. The trend lines are the same. There's our, just like on QQQ I showed you, we had sell signal number 1 right here on that trend line break, sell signal number 2 there, and this is comparable to that 401 level on QQQ. You can see a lot of reactions there. Reactions there, a little one right there, another one right there once we back tested, once we broke it. So this, in a nutshell, what you had here is a failed breakout to new highs. There was your previous all-time high. This breakout failed, and at least here on this time frame, and then you back tested several times. You even put in a divergent low here, which give you this rally, and we back tested, and we keep getting rejected. So as big as that level was, that's 16,442 now on this roll chart. It's even bigger now because we continue to get reactions. So the more reactions on a trend line, especially clear and distinct reactions like that, to me, the more valid it is. Again, traders are trading this. The people are looking at the same levels we are here on these charts. So it makes sense that there would be quite a bit of stops there, and if the bulls break it, and it's anything but a little whipsaw, we'll probably get a lot of buying coming in. But again, I see a lot of failures there, and maybe that's the last chance. But there it is. We're coming up on support now. So We're really pinched between the 16,442-ish level as resistance and 16,129 support right there, and same levels. We already hit that. Again, these are adjusted targets, but that was was a target on the previous on the December contracts there, and it equates now to about 15,553 right there, and that was our last low. So if we head on down there, remember that was only T2 on that QQQ chart. So I have additional targets here. I don't know if I've updated the, let me see if I added the lines here. I've been working on a lot this morning. Yeah, I did. I gave you this before. Again, now these are the March contracts. So this is the if things get ugly target all the way down there to about 14,427. And that's going to be a nice drop if we get down there. It's going to be better than 10% or so from where we're at right now. Okay, so now we're going to take a quick look at the top holdings in the Nasdaq 100 and then flip it over to look at the bottom holdings. And so you guys are probably familiar with the old Dickens classic Tale of Two Cities. I call this a Tale of Two Tapes. There's one tape, and that's the tape of the market-leading FANG stocks, and that's a bullish tape. They are literally you know, Teflon stocks, bulletproof. Or have been for quite a while now, but that's not the case with the rest of the Nasdaq 100. And that's what again, this is my segue into market breadth deterioration. And I'm also going to go to specific breadth indicators after this, but let's just rifle through the top components. So what I have to the right of this screenshot here is a list of all the holdings in the Nasdaq 100, and I have that sorted by market cap, starting with the largest. So this is Apple. It's a $2.9 trillion company. I mean, that's just insane to say 2.9 trillion in market cap. And again, it's just been a resilient stock. You turn off all the lines, forget about, you can just see it going up. And bottom line, look at this, near all-time highs, unstoppable, right? And really, you know, just burning through these divergences like they're not even there. Microsoft, here, we can let's turn off all the lines and just show you this. You have divergence on a lot of these, don't get me wrong, not all of them. Actually, just about all of them. But still, they keep going up, and divergences are not a sell signal. So that's what we really need to get some trend line breaks and drops below like the key moving averages, like the 200 days. And these stocks are well above their 200 days. So there's Microsoft. Here's Alphabet Class A. Again, all these stocks at or just off all-time highs. Amazon, kind of moving sideways, but a lot closer to its all-time highs than or 52-week highs and its 52-week lows, right? And right off all-time highs. Tesla, now one of the big ones up there at about 993.8, almost $994 billion, so close to the $1 trillion club. And again, not far off all-time highs, you know, but as you can see, close enough. And then you have Facebook or Meta now, Meta platforms. Again, turn off all the lines and, you know, just roll back. And here's a stock. Now this one corrected quite a bit, but still comfortably above all-time highs. Or I'm sorry, close enough to all-time highs. Put in a divergent low there. I mentioned that as one of the most bullish in the of the FANGs right here when we had this divergent pullback to support, 297 support. And it's been a nice rally so far. Again, that was the best looking one at the time. I'm going to give you some other trade ideas for those of you that don't share my longer term, intermediate to longer term bearish outlook right now. I'm going to give you a handful of potential long trade ideas. They're certainly objective. Whether you play it or not, whether you take them or not, that's up to you. Last but not least, we'll look at NVIDIA because it's up there too. It's $761 billion. Divergence and all that, but you know, bottom line is it's, you know, right off its all-time highs, and that's the story with the market leading stocks right there. Now we're going to flip it upside down. I'm going to reverse the market capitalization here. So we're going from the smallest, and that is Peloton. Peloton is, you can see here, peaked back in November, and I'm going to grab the level we were at there. And that is a 78% drop. And I mentioned Peloton as a short back here, actually off the divergent high. Been bearish on that one for a while. That was had a big run up at the stay-at-home thing when COVID hit. Everybody buying exercise equipment, working out at home. Well, people started to go back to work and got the vaccine and moved on with their lives. And either way, so Peloton's dropped. Now it's a trade idea. Look, this is support right here. It's pretty good support, way oversold. potential divergence forming right now. It could take a little bit more downside or not. It has potential divergence right now, higher highs on the indicator, so I just want to throw that out there. I'm not giving you bounce targets now. You just buy it, set your stops. Again, if you are bullish. It's going to be hard for me because I'm going to get to these breadth indicators in the Nasdaq 100 in a second. But I may take some of these individual stocks as hedges, or find something else out there. Treasury bonds, gold, silver. There's always something going up if the stock market's going down or even sideways. So let me just move on there. Next one, again, going up from the bottom, is INCY, and that one's also at support with positive divergence here. Oversold, no divergence on the RSI, but PPO divergence, and pretty good support there, about 62.52. Maybe a trend line right there to watch. That would, if you took a position here, you could add it on. So again, these ideas are for those of you that are either looking for pure play individual long trade ideas. Could you short it on a break of these support levels? Yeah, but be careful with those with divergence and those that are very oversold, because short squeezes are always a possibility. But again, the takeaway, and I can't impress this enough, is look at this. Here's a stock. Remember where all those market leading FANGs were, right at or off all-time highs. Here's one down 60%. It peaked back in 2017. Again, so I'm going in order here. TCOM, trip.com. This one doesn't have divergence yet, but if it makes an equal or lower low anytime soon, it's going to have positive or bullish divergence. But again, common theme here. This is a stock that dropped back in 2017, or peaked back in 2017 and fell 67%. So it just goes to show the overall health of the stock market isn't as good as the, when you look at the major indexes. And believe me, SPY has the same kind of situation, because the top weighted components in the Nasdaq 100 are also top weighted components in the S&P 500. CHKP, I'm not going to go through many more, guys. You can see a lot of these have divergence, but again, they peaked and they're well off the highs. Here's one that peaked back in 2020 and fell so far about 23%. And it's a common theme. I'm not skipping over any. I'm going up from the bottom, showing you that the majority of the stocks have been falling. Here's SPLK. Again, support, pretty decent support there, about 107.50. Put in a divergent high recently right here after the big divergent high that's been, this one's in a downtrend. So a lot of these stocks have topped and are in larger downtrends. And I'll tell you what, if the market, the Nasdaq 100 goes where I think it's going, these guys are going to get dragged down too, most likely. They're the better looking ones. You could go with a hedge portfolio. I mean, you could be short the FANGs right now and long these guys. You probably outperform because when the market finally cracks for good, the FANGs are going to get hit hard. Money flows, so it works both ways. Flows into the ETFs are going in and boosting those share prices, the big market leading FANGs. But when you start getting outflows, when everybody says, oh, you know what, I'm going to pull my money out, I don't like the way the market's acting, and everyone does it at once, you get a crowded rush for the exits, and that's what I think we could have here. Then you're going to see those guys really fall. There's FOXA. I'm not going to go through too many more. Let me go down to, let's just rifle through these quickly. That was at support as well. Here's another one, CERN, divergent high. So there's a stock that peaked back in or beginning of 2021. Sirius XM Holdings had this crazy little wonky spike up there on some news and still well off its highs. SGEN peaked back here in 2020, October. So far, and from there it fell about 38%, and it's been making lower highs since. So divergent high there, high, lower highs, and once it takes out, if and when it takes out 133.52, it's going to have another lower low. And so it's all the making. A lot of these stocks have rolled over, is my point, on the charts. These lower tier stocks, still components of the Nasdaq, and still good sized companies, by the way, guys. I started out with Peloton. That's $12.2 billion company. They're not small companies. I'm not looking at the bottom of the Nasdaq Composite Index, which has thousands. This is the Nasdaq 100, the largest 100 stocks in the composite. This is SWKX, $26.6 billion company, divergent high, and it's been moving lower. Clearly, in an intermediate term downtrend. Longer term bull trend, no doubt about that. This is a long-term bull market, but only time will tell how much further this one's going to go. All I can tell you is it has, like so many others in there. And here's a short setup. This one hasn't broken, well, broke down. It broke the primary trend line right there, and that's CDW. And it set up the secondary trend line, and your next sell signal is going to come on there. I think at minimum that stock's going down here at about 150 right there. Let me give you a line. Again, the point of this was to give you mostly, for those that want long side trade ideas, some of those that already beat down at to support. 22% drop, 147. That's where I think that one's going. So that's about it. Let's not go through too many more because I could do this all day long. DocuSign, boom, another benefit of when COVID hit, everyone doing the online using DocuSign. But and here's an example. You see a lot of stocks do this. Looks like Amazon, so many others that have been trading sideways for the last year or so in these same toppy type patterns. And they had, like this one, you can see that breakout, false breakout. It failed. This is a great example. This is what I'm looking on the indexes. I'm looking to see. You had a breakout there. It was bullish, right? Breakout to all-time highs after breaking above this sideways trading range. It should have done that, especially after back testing a couple times, but it didn't. It broke down back within the trading range right here. Breakout failed, back tested, failed, back tested again, couldn't get through that 280 resistance, and then boom, that's all she wrote. She gapped down, big gap down below the range. And this is what I think so many of those other stocks will ultimately do, such as Amazon and quite a few others that I've showed you in comparable trading ranges. Okay, now to the good stuff. We're just going to focus on breadth indicators, and I've got a lot of them. I'm not going to cover each and every one. Most of them I'm going to focus on the Nasdaq and the Nasdaq Composite and or the Nasdaq 100, but there's some other indexes in here I might hit as well. The story's the same on most of them, but it's just most pronounced in the Nasdaq. Alrighty, and again, I'll rifle through pretty quick. I've covered almost all of these in the past. This is one of my favorites, the NAAD we're looking at up top. That's the Nasdaq advanced versus declining line. So it shows you the number of stocks in the Nasdaq advancing versus declining. So you would think in a bullish bull trend, an uptrend, you'd have more stocks advancing than declining, and you usually do. Green arrows down here, I'm overlapping them, show when that was happening, when the right here, the NAAD was going up along with the market, and that usually happens at the end after a bear market is over a big correction. That's usually when you see that. That's very healthy, and again, that happened back in 2009, and that launched this great bull market that has been here since. And you can see a lot after a lot of the corrections. But what happens, what's a red flag, is when the stock market's going up, as it was back in 2005 and into 2006 here, and you had a pretty big correction back in 06. We continued, we had another thrust up in the stock market. Down below is the Nasdaq Composite, and breadth continued to deteriorate, meaning more and more stocks were falling than were actually rising, yet the market was going up. And that was a big one. That was a doozy of divergence there. Look how many years and how big it was. And then what followed? About a 55% bear market. A lot of people got wiped out in that bear. Okay, and you can see every other one's marked, every single divergence, all these blue lines that you can see on this chart. You can pause the video and freeze it. And I also have down below circled the corrections. And these were big corrections. It doesn't look like much because of the scaling, because of the time frame I'm using on this. We're going back to 2004. But these were all double-digit corrections. Some of them, such as this one, that was a... Yeah, I said 36%. I think the S&P dropped 36%. The Nasdaq was a little less on that drop, but either way, it was a big one. Fourth quarter drop right there. Oh, we didn't even have divergence on the Q4 drop, but we did when COVID hit. Like I talked about this before. COVID was most certainly the fundamental catalyst for that correction, but the technicals were already pricing in a big correction with again, this one of my best indicators. And here it is. So bottom line, look at that divergence. This is the NAAD up here, just falling off a cliff while the Nasdaq 100 powers on to new highs right here, and without anything remotely close to correction. So the takeaway, guys, is that history doesn't always repeat, but it often rhymes. And when you get these divergences, especially substantial divergences like that, it's usually followed by a double-digit drop. So that's probably what we're looking at coming up. In Will it happen in December? Well, maybe. December is historically a bullish month, but you never know. There's a lot if you want to make a fundamental case for a bad December, might be tax loss harvesting, a lot of selling to offset gains. We know that taxes are going up. We know the current administration wants to raise taxes and will raise taxes. We know that, my goodness, we have to pay for all the free money we've been giving out lately. That's coming down the road. So why not book some gains and harvest some tax losses now? Who knows? Anyways, let's just see what happens. Again, these right here, and everything as I'm going through on these breadth indicators are not, and let me repeat, they are not timing indicators. They are conditions in the market, and these divergences can build. They were divergences there, then we had divergence there, here, kept going. The divergence got bigger and bigger. Finally, that big correction or slash almost bear market back in 2015, 2016 set in, where we went sideways for a year and a half and down, two big corrections within there. So again, divergences are not a sell signal. Market breadth deterioration is not a sell signal. It is a condition of what's going on within the market, and those conditions usually will lead to corrections. Not always, but usually. Next one up, this is the NAHL, and that is the Nasdaq New Highs to New Lows Index. So it's the black line on here. I have a black and a red, but the black line up top is the NAHL, and then I overlay it with a 20-period exponential moving average, or I put that on there. And what I look for is crossovers, and you can see, I know the lines are so close, you're not going to see them. It's going to be almost impossible in the video to see when they cross, and that's why I set this histogram up, a custom histogram that will tell me when the lines cross. So you have the zero line in the middle, and so when that histogram is above the zero line, the lines are the NAHL is above its 20-period EMA, and when it crosses below there. And so you can see I put red lines where they've crossed over the years. Now what you can see here is you can get there's some occasional whipsaw signals here, but it's caught all the big turning points in the market. This is that bear market again, 2007 to 2009 right there, 55% drop, and it was preceded with, you had a pair of those sell signals there, and that trend indicator stayed bearish. That histogram, in other words, the NAHL was below its 50 or 20 period EMA throughout almost the entire. It was almost a perfect timing indicator for that bear market. Would have got you out of your longs. Again, there's some whipsaws along the way, but you have to respect when it crosses over. And again, here's all the corrections over the years down below the Nasdaq Composite. They're boxed in, and I'm showing you those. I've already had them boxed in red. Nothing yet. And by the way, we've had a cross. This zoom in right here shows that when the cross was made back around December 22nd or so, right there, right? The lines are clearly crossed over, as is evidenced by the histogram. And look how steep. So we've had a few whipsaws, and again, you're going to really have a hard time picking them up in this video, and unfortunately I can't just drag and expand this box, but I can tell you right now the histogram is solidly negative. So the crossover looks like the real deal this time. This was the real deal. This was a real deal. That was a 20-something% drop. That was a 30-something% drop. There was a real deal, 2015. The rest were little tiny whipsaws, so you usually didn't see the lines get this far below. So this one's on a solid and pretty clear sell signal. In fact, the best sell signal since COVID hit back in early 2020. And before that was that huge drop in the fourth quarter 2018, and before that the histogram hadn't been this low since back in 2015, 2016, when we had two drops of almost 20% and sideways market. So another one that's firing pretty much sell signals, if you will, or yeah, that one's more of a hard sell signal than conditions, because if you just take the crossovers again, you could treat that as more of a sell signal. All right, next up is the Nasdaq. This is the NAA 200R, and that is the percentage of stocks in the Nasdaq Composite trading above their 200-day moving average. So you can see on the scaling, it tends to get about 80% on the high end during strong bull runs. By the way, we're going all the way back to 2002 down here. So back in 2002-03, right there, we got up to about that 80% mark, and that's usually about the extreme to see about 80% of their stocks trading above their 200-day moving average. We saw it happen again in early 2009. That was in the very beginning of the bull market back, the bottom. Remember, the bear market ended in March of 09. We rallied up and hit that early on. That was, markets were explosive back then, coming off that huge 55+% drop, and we hit it then, and we just hit it again recently. And you can see what happens. So when you hit it, that's not the sell signal. When you hit it, then you come in and you make another lower high in the NAA 200R, i.e. negative divergence on that indicator. That's when your correction set in. So there it is, all double digits, and all the big corrections and bear markets since going back decades here were all yeah, I don't think I've missed any. These were the biggest ones. They were all preceded by negative divergence in the, and see, you don't always have to get up to that 80% level. Here we just had negative divergence. We had a correction, a little one there, and the divergence continued, a bigger correction. And that was that fourth quarter drop of 2018. There was COVID right there. Didn't look like much when you zoom out so far in time and you're using log scaling. But again, I think anybody listening to my voice now would certainly remember that drop in the market. And here we are. Now here's the thing. So divergence can, get the scope of the divergence I look at is how long it builds in time. And you can see sometimes you have a little bit steeper divergence line than others. This one, we're falling off a cliff. This is unprecedented, guys. And this is why I'm doing this video, even though I've covered these in recent weeks. I covered it back here, I've covered it here. We continue to fall off a cliff. This is the percentage of stocks trading above their 200-day moving average. It's down to about 25% right now. Well, 29 today, it just hit 25% the other day. Yet the market's whistling Dixie, going on to new highs. Crazy stuff. So again, guys, I'm sorry, I'm not looking for a correction anymore. I'm looking for more of a market crash or, big swift drop. I think there's going to be a crowded rush for the exits when these play out. And again, the takeaway from this is, look, you can't just go short in everything. You can when we get additional evidence. That's why I start with the 60-minute charts. When those support levels I gave you break, or you rally back to resistance, you can objectively add short exposure. And I'll tell you, if we're coming up to an all-in moment. When I say all-in, don't put all your portfolio short the stock market. Whatever portion that you decide to go, if you do short, that is, you might not even short. Your takeaway might be to get out of your longs, if you believe this, that this stuff's going to play out. But you want to say you're going to put 30-40% of your portfolio short the equity markets, then that would be your all-in moment, all in up to that 30-40%. Right now you might be at 20%, but you might have other trade ideas out there like sugar, coffee, or treasury bonds, or gold and silver, and that's the rest of your portfolio. Again, I think it's just financial suicide to put all your money in any one particular security or asset class. I like to diversify. Okay, some of these I may duplicate. I have so many indicators. I don't know if I covered this one. This is the Nasdaq NAAD advancing versus declining issues. Yeah, I did cover this early on. There it is. Yeah, 70. I measured the drops out here: 55.7, 20.4, 20%, 31%. That's what it was in the Nasdaq. There it is. Clear divergence. Again, you can see the divergence lines are there on the chart. You can see what happened afterwards. And again, history doesn't always repeat, but it often rhymes, and hence the reason for this video. I've covered that one before. This one is the NDX versus, okay, this one is the equal weighted Nasdaq 100 versus the Nasdaq Composite Index. And what I've showed you here is, a healthy rally. There it's going up, the ratio of the equal weighted Nasdaq 100 to the Nasdaq Composite. And then when you start having these drop-offs here, when the equal weighted index starts to underperform the Nasdaq Composite, that's usually when you've had some big corrections there. You can see them all measured out there. And there was divergence. You can't see it to the left of the chart when that big drop happened back then in 2008. Here's the chart. I haven't cleaned it up in a while or marked it up, but I just wanted to pick up on it. It's NYHL. That's the NYSE, New York Stock Exchange. New highs, new lows index. So right there you have the new highs, new low, and you can see that is also diverging. Look at the drop off there. As down here, the S&P 500 continues to power on to new highs, and that falls down there. And again, is the Nasdaq Composite's not the only index in town. Here's the NYSE, the NYUD. That's the NYSE Advanced Decline Volume. So the advancing versus declining volume, the issues. And you can see right here, we had divergence. This is the NYUD, that indicator, with the NYSE down here. Stocks are going up. And I'm sorry, that was not divergence. Why do I even have those lines there? This is divergence right here. You can see. Oh, okay. I don't. This chart I must not have visited in a while. I'm rifling through. I told you I have dozens and dozens of indicator charts. I don't know why this one's up. This, I'm going to take this away right now and tell you that's not divergence there. That's not. This is the index down here. This is when you had divergence. Nope, we had them both going up. This is the first divergence. This is it. This is why I wanted to update this. Again, I didn't even pay attention to these old lines. I'm looking right now. You have them both going up. Again, the NYSE is down here. This is the first divergence and clear divergence in some time. And I just wanted to show that it's not just the Nasdaq Composite. You have the NYUD, again, the advanced versus declining volume line, sharply going down with the NYSE going up. And that is negative divergence. Okay, and this is a good one here too. This is the NAHL. Again, if I already covered it, my apologies, because I have a lot of these in different iterations, different variations on these charts. But that's so the Nasdaq new highs to new lows index. So that's what it's showing you. All the stocks in the Nasdaq Composite, the new highs versus the new lows. And again, I like to overlay that one with the 20 EMA, and I might have already showed you that. I think it was early on. It might have been a different, similar indicator, but either way, it crossed over. It's clearly crossed over in the zoom in. And again, you had that red sell signal fire back when COVID hit. It caught that early on. It caught that big drop in fourth quarter 2014. Again, when I say caught it, I mean the NAHL crossed down below its 20 period EMA, and it's caught all the big corrections early on. And that's the thing. This one is more of a timing indicator, as I believe I mentioned before. So let me move on to the next one. This is the NASI. That's the Nasdaq McClellan Summation Index ratio adjusted. And you can see here the divergences here. You have negative divergence. There was a bear market, preceded that bear market, 55+% drop. Negative divergence preceded that 18.5% drop, 20% drop to this divergent high right here, followed by another 20% drop with that additional or extension of that same divergence. Again, that was that sideways, called deer market, where we didn't go up or down, but we had two big corrections in between in 2015 to 2016. Divergence there, 26% drop. Divergence there, 31.5% drop. That's when COVID hit. Again, clearly identified in advance by the divergence. And look at this. This is big divergence. And so, again, that's going to indicate a drop. And if you look at what these averaged about 20 to 55%, anywhere in between. I know I covered the NAAD earlier, but I believe that was a daily time frame. This is the NAADW, meaning weekly. So this just shows it on a weekly closing basis. And again, that's the Nasdaq advancing versus declining issues on a weekly. So this is a big picture. We're going back 2 decades here. You had big divergence, big negative divergence leading up into that great bear market. Nasdaq got wiped out, like 70-something% down during that bear market, because that was the dot-com bust. And again, it was preceded by that drop-off. Now, once the stock market's going down, yeah, you expect the NAAD to continue to fall. Then you have a lot more stocks falling. You had a bull market after that, but then we started to diverge, leading right up to, you got it, that was the next bear market back. So on a weekly chart, we're looking big picture here, 55% drop, preceded by the negative divergence. Corrections here in the bull market early on, big correction right there. big correction or bear market back there, fourth quarter 2018, and then COVID, all again preceded by these clear negative divergence. You don't have many of them. And again, I don't see a period where you had them and they didn't play out on this frame. Now you have that steep divergence here. So it's going to indicate, again, it indicates to me good size one coming up. Now look, maybe the divergence continues to build, and that's why we need to see some additional sell signals on price. You know, sell signals on the price chart of Nasdaq 100, S&P 500. We want to see us get well below those bearish engulfing candles we put in on the weekly recently. Want to see some of my weekly and monthly trend indicators roll over, because again, the market is still comfortably above its 200-day moving averages. There are almost all long-term indicators are still solidly on buy signals, saying we're in a bull market. But the problem is, you know, by the time those all trigger, based especially how far away we are from those, by the time you get those to flip to bearish, you're probably going to be down 20+% in the market. So just keep that in mind, that once those trigger, then that's our longer-term trend indicators, and that tells you to start really putting, you know, long-term funds more on sell the rips and cover on the dips kind of trading. And yet another breadth indicator. This is the ADL, well, so let me just call out what it is. The Nasdaq Advanced Decline Line. And so you can see there the divergence, bear market back in 2007 to 2009. First big correction in the bull market, preceded by negative divergence. There's your divergence line. It's showing you the correction there in the red box. Negative divergence, correction / bear market 2015-2016, divergence, COVID, boom, 31% plus drop, 36 in the S&P 500, and then today we just continue. This line just continues to just market. We had market breadth deterioration there, and guess what? It didn't play out for a correction. It's gotten worse. And it's possible that we shrug this off. Yeah, and the thing is, when I just started the video and showed you some of those lower tier stocks, and I obviously didn't cover all of them, but I covered about the top 10 or dozen or so. Quite a few of those you could make the case to step in and go long because you're at support, and some of those had positive divergence. So if you have, let's say, the majority of those smaller names start to participate and play catch up, maybe you see the market kind of do whatever it does, but you see this line start to come up and then take out this divergence. But we're so far away from that divergence being taken out that I think at best case scenario now, maybe this market has a few more weeks or months left in it, and we get a little reprieve here when the lower tier stocks rally, but we're guaranteed anytime soon, and I say anytime within weeks or even a couple months here, no matter what the market does, and the rest of those stocks, we're still going to have negative divergence. It's only going to get bigger. But right now, like I said, it's about as big as it usually gets before corrections set in. And I shared this recently in one of the recent videos. This is the old the Nasdaq. I'm sorry, the Hindenburg-Omen, but I made my own variation. Hindenburg-Omen is based on the NYSE and all those breadth indicators. So I took the same breadth indicators, but I used the Nasdaq composite and all the Nasdaq breadth indicators to come up with it, and use the same criteria, and it fired for the first time in a while. It's fired a sell signal, and this was an old indicator. It used to have a lot of following because it called quite a few or several market crashes back in the day. Then in recent years, and again, I'm speaking more to the one on the NYSE. No, but I've never seen anybody use this variation of it. It's done a pretty good job, and when it fires those, it's just telling you that things aren't well under the hood. You have everything that I'm talking about. These breadth indicators means the market's going up, and then all of a sudden you have some unusual disparities in the breadth indicators. And so I just wanted to say it triggered recently a sell signal, if you will, but it's not, and nor has it ever been a timing indicator. The Hindenburg was just, again, showing market conditions that often precede a market crash or big drop. I'm sorry to use the word crash. I don't want to be overly dramatic. I'm just talking a big swift drop. Let's just call it 20% or more. And yet another. This is the NAHLR, Nasdaq new high to new low ratios. You take the ratio of stocks making new highs versus those making new lows, and a couple things. Usually this dotted line here, or dashed line, is about the upper limits of where you get, and then corrections or bear markets usually start. It had triggered just to the left of the chart. This was the dot-com bubble burst back there. It was actually March of 2000, so it's just to the left of the chart, and it did fire off there and warned of that bear market that came. The next bear market we had was 2007 to 2009 right there, clearly preceded by negative divergence on that indicator. Negative divergence then, correction. Negative divergence there, correction. Negative divergence into this high right here, correction. Again, 15, 18 months of sideways action with two drops coming close to 20%. Some indexes actually dropped more than 20, like the small caps. Divergence in the fourth quarter of 18. So this indicator fired off, gave you this warning sign, and then we had that big fourth quarter drop in 2018. And then you had, again, divergence here. You had equal highs, so you kept divergence going into March of 2000 when COVID hit. 31 to 36% drop, depending on the index you're looking at. And then divergence again, big divergence. That's the thing, guys. That's why I'm spending 40 minutes talking about showing you it's not just one, it's all these indicators using different metrics, you know, whether it's percentage above a moving averages, key moving averages, whether it's a ratio of stocks making new highs to new lows, whether it's based on volume. They're all telling the same thing, the same story right now. All right, we'll wrap it up. I think I already covered this one, the Nasdaq percent of stocks above their 200-day. I might not have covered the 50-day, but again, you can see all the divergences. These dashed lines, the vertical lines show where the tops came after the divergence. 54% drop, 20%, 20, roughly 13, 18, 25, 30. And what? This is big. Look how steep that divergence. We're falling off a cliff here. Usually you get the divergence isn't so pronounced and you still get these double-digit drops. This, I've never seen anything like it, not even back in the time of the dot-com bubble. So, you know, we could see something well south of or north of a 20% drop. And I don't think I showed you the 50-day. Same thing as we're just looking at, except instead of the percentage of stocks above their 200-day moving average, this one shows the percentage of stocks on the Nasdaq trading above their 50-day moving average. And so you can see recently we hit a multi-year, maybe probably an all-time high, about 90% of the stocks back here right after COVID, right when the Fed stepped in with the nuclear response. It got up to about 90% right there. And remember, you can't go more than 100, because that would mean every single stock in the Nasdaq is trading at their, above their 50-day moving average. But again, it's simple stuff. It's these divergences. 54% drop. Each and every one marked and measured here. 19% drop after that divergent high. 18, 15.5, 18, 19, 24, 30, and yet this is the biggest divergence, not just in years, almost in history, and nothing yet so far. So maybe we're entering a new era where these mega, handful, the multi-trillion-dollar companies are just going to continue to move up. And I will admit they are, earnings juggernauts. There's a lot of financial engineering going on, as you guys know, with share buyback programs. When you're a multi-trillion-dollar company, you've got a lot of money to get put into some of the smartest people in the world figuring out how to use financial engineering and accounting methods to your benefit to buoy your stock price. So we know that Apple's been doing that for years, strategic share buybacks and things like that. So yeah, all I'm trying to say is it can continue, but again, we're going back as far as I can roll back on these charts here. And if this doesn't play out for at least a double-digit drop at some point, then I would be really surprised. But again, not shocked. And you don't position based on this chart. You position, or you strategically or tactically enter and exit your positions, whether you're long or short the index, based on, first and foremost, what's going on the daily and 60-minute and weekly charts, price action. But the whole takeaway, the whole point of this video, and I will wrap it up here, is it helps to formulate, okay, do I want to just hit that, let's say you covered at T2 on my QQQ chart and we hit T2. Is that it? Is that all you're looking for? Or are you open to the possibility, instead of getting that quick single or double, do you want to hit the home run or the grand slam and maybe position, and if we're early in on a much bigger drop, with another 15-20% or more downside? And this certainly says that is possible. So we'll wrap it up here, and if anything changes on this, I will do somewhat frequent updates on this, no more than every week or two. But for now, let's just focus on those levels I started out in the very beginning of the video, the support and resistance levels above QQQ and NQ, and we'll go from there. This has been Randy Finney with Right Side of the Chart. Have a great day.